Hello, everybody. Welcome to this weekend's episode of the Weekly Wrap. This week's episode is episode 12, and I really want to talk about why market bottoms, true market bottoms, really require a level of panic, pain, despair, just a complete loss of hope. And before we start, I just want to say if you enjoy this type of content, we release one of these videos every weekend that go more in depth into what happened in the market that week, and every day that the stock market is open. I release a short video that just kind of recaps what happened that day. If you like that, be sure to subscribe here on YouTube and follow us wherever you listen to podcasts. Today, I'm going to be talking about kind of what causes a market bottom and if we're anywhere near there now. So we'll look at the bond market versus the stock market. We'll look at some of the hedging that's happening right now. We'll look back at previous bear markets. We'll look at the volatility index, the VIX. We'll look at Bitcoin, and we'll look at a lot more too. So let's get into it. So the first thing I want to look at is the fear and greed index. So when this is reading where it is right now in the extreme fear zone, that's generally when you at least would see some type of bounce in the stock market. That's generally when you'll see either that bear market rally or the bottom in the market, depending on what else is going on, and vice versa. When you're in the extreme greed category, you'll see more pullbacks, corrections, crashes, things like that. And right now we're reading extreme fear. The market is very fearful. Retail investors are bearish. Institutional investors are bearish. Governments are bearish. Everybody's bearish, and everybody can't be right. So that's usually what you want to see if you're trying to predict a bottom in the market. But there's other things that need to coincide with it if it's going to be a real bottom or just a bear market rally. So another thing I just want to quickly mention is real wages are falling. So while inflation is becoming a problem and all the other things that are reducing the consumer's ability to spend money, the wages are falling as well, real wages, which typically takes into account inflation. So inflation's outpacing wage growth, basically, is what this chart is saying. And that affects the markets because not a lot of money is being invested. There's less discretionary money for people to be able to spend at these companies, so earnings may go down for these companies. You'll see earnings recessions during a time like this, and just overall it's not good for anybody, and especially the people who are losing income at no fault of their own. I saw this chart this week, and I just wanted to mention it because it's just kind of mind-boggling if you look at the difference in wealth controlled by each generation. And look where, so Gen X and the millennials are down here. This is when they were getting out of college, and this is where their wealth was at. Look at the baby boomers when they were coming out of college. Look at their wealth. It was just a lot higher. I don't even know how that can be completely accurate, and it might not be. But the point still remains the same, is that the baby boomers right now control about 57% of the wealth in the whole world, and that's not good. And not only that, but it does mean that there's going to be a big wealth transfer. And I think it'll be interesting to see how that plays out, whether it stays in the families mostly, or if it goes to charity, or just what will happen when the baby boomers start to transfer that wealth down to the next generation. So this is a chart that overlays the S&P 500 this year to 2008, and this was actually about a week old. So since then, we've actually come down even more. So we actually should be like right around here on the S&P for this year. So it is actually still keeping track with the 2008 S&P 500. And while there are a lot of people freaking out now there are also a lot of people freaking out in 2008 when we were at this point, and there was still a lot more pain to come. So just because you're seeing all this bearish sentiment doesn't necessarily mean the market's going to bottom, but it makes the chances better than if people were bullish. So this is another just kind of like a troubling trend in the macro environment. So this is the S&P 500 overlaid with the real 2-year yields. And you can see that the real yields are just crashing because inflation has been going up. So even though the Fed is raising interest rates, growth is slowing and inflation is going up, so the real yield is going down. And typically over the last 4 or 5 years, they've been quite interlocked. And right now, real yields, if the S&P 500 was where it has been compared to the real yields the past few years, the S&P 500 would be back down to where we were during the COVID crash, like the bottom, like the S&P 500 would be around 2,400, 2,300. So that's troubling. If the market's to keep pace with that, then yeah, there's a ton of more pain to come. I do think if we got that low, we would see buyers come in before then, or the Fed would get involved. But it definitely opens the door for the S&P 500 to crash a lot lower. And another thing I wanted to look at is the 20-year plus treasuries. So basically just long-dated bonds, just the bond market in general, and the S&P 500, and what happens during a bear market. So this goes back through every bear market since 1961, and you'll see that the bond market outperforms the S&P 500 during every single bear market, and usually it does so by a lot. So fast forward to 2022, and here is the bond market with the stock market during this bear market, and bonds have actually done worse than stocks. So that can mean that bonds are going to outperform heavily to the upside from here. Maybe bonds go up while the market kind of stays in a range or something. But I think what's more likely is the stock market needs to go down lower, because that would coincide with what we're seeing here with the 2-year real yields. That would coincide just with what we've seen in the past in similar situations. The stock market has more room to go down. And it could mean that the pain is not completely over. But I do want to talk about just this phenomenon of the bond market doing horrible. I want to take a look at the 60-40 portfolio over the last 100 years almost. So since 1928, this is the 1-year return for every year of a 60-40 portfolio, which would be 60% the S&P 500 and 40% U.S. 10-year Treasury, so the bond market basically. And you'll see that this year is the second worst year ever. The only other year that was worse was 1931, and that portfolio would have been down 27.3%. You can see that we'll go stretches of many, many, many years, some decades, without having this portfolio be in the red, and this year it's down almost 20%. So that's really, really extreme. We haven't been down more than 15% in this portfolio in a year since 1937. So this would actually be the third worst performance ever. But since 1937, we haven't seen more than 15% down in that portfolio, and it's down that much this year. So yeah, maybe it's a bad year this year, but maybe that means that it won't be this bad for a really long time. I want to talk about what's happening now with institutions hedging and just the overall market trying to hedge to the downside. We're seeing put volume at record highs, so there's a record amount of puts being opened in the market. Usually when you see this much activity going one way in the options market, the general market will swing the other way. Just that's also related to what I was talking about earlier with just the overall sentiment kind of being an indicator of where the market could go. But really, if you're a bear on this market, you don't want to see this many people getting into bearish positions. Generally speaking, if you're entering a trade, you don't want to see the majority of the people going with you in a trade. because the market will typically go the other way. And kind of along those lines, if you look at this is called the McClellan Oscillator. So basically it shows if the market is overbought or oversold. To the upside would be overbought, to the downside would be oversold. And this is actually the most oversold we've been since 2020. So when we hit the bottom in March of 2020, this oscillator was at negative 136.48. Right now it's at negative 115.38. The only other time it's been at or above 100 was during the global financial crisis when it barely cracked 100. And since 2000, it hasn't really gotten anywhere near there. So the market is telling us that it's oversold. Sentiment is telling us that we're too scared. But there are still a lot of indicators saying that there's a lot more pain to come. So it can definitely be a confusing market. It's definitely a confusing market because, I mean, we've never seen the Fed tighten this hard, this fast. Interest rates have never gone up this sharply, this fast. And we've never had an environment where the Fed is shifting to such a hawkish stance during a recession when the market is weakening. So it's just a confusing time to be an investor. Obviously, with these low prices in the markets, it's a great time to be a long-term investor. If you have a long time horizon, obviously dollar cost averaging into this market would be a good decision. That's really the only way that you make wealth over the long term is by being a long-term investor. And how do you increase your expected returns over time? You get in at lower prices. So this is exactly what you want if you're a long-term investor with a long time horizon. It's scary, it's confusing, but sometimes you just have to stick to your plan anyways. That's usually how the most money is made. So what happens when markets are this oversold? So typically they are associated with a market bottom. We've seen puts come into the market like this only in 2008 and in the early 1990s. So in the 90s, it indicated a bottom when that reading was hit. Typically, it happens two times, once before the mass capitulation and then once right at the bottom. So this is our first reading, which would say that there could definitely still be more pain to come before we get this reading again and the market actually bottoms. So in 2008, we had it right here, and then it sold off a little bit more. We got the reading again, and then the rest is history. So this is our first reading right here. We could come down a little bit lower, get another reading right here, and then go back up. So this chart, we talked about it last week, but I just want to keep it in here to remind everybody, this is what the markets do following a 20% or more drop. So stocks could continue lower, but discounts are good for long-term investors. So if you look at 2 months later, it's typically negative most of the time. When the market falls that hard, you typically have some more room to go down. Even 3 months later, it's pretty mixed. But if you look at 6 months later and 1 year later, look at the 1 year returns after a huge drop. This is what I mean by how you can enhance your expected returns. In the average year, the S&P 500 is expected to go up 8 to 10%. But if you invest right after the market drops by 20 or more percent, you can expect your returns to be somewhere between 10 and 27% based on these drops, these historical drops. So it's an easy way if you're a long-term investor to increase your expected returns, just dollar cost average into markets that are getting beaten down. And history tells us that the market recovers after every single crash. Obviously, that doesn't mean that it will recover every time in the future, but how else are you going to build wealth then if you don't even have the confidence and the discipline to invest when prices are at their cheapest? So kind of similar to that last slide, we also looked at this last week, but this is what the NASDAQ does after a complete drawdown. And a complete drawdown is after every single company in the NASDAQ 100 declines on a given day. And this happened last week. So What typically happens in the short term is markets keep going down or they're mixed, but look at the 1-year returns. Your lowest 1-year return after a complete drawdown is 7.7%, and your highest after that complete drawdown is 78.1%, which is what happened in 2020. I'm not really sure why. Okay, yeah, I was just reading that wrong. I was reading that as this line, but yeah. So in 2020, after the market crashed like that, the 1-year return was 78.1% on the NASDAQ 100. So what will happen? Where will we be September 13th, 2023? History tells us we'll be a lot higher, at least on the NASDAQ. So yield curves, the bond market. So we've looked at this the last couple weeks. Again, the majority of yield curves are inverted, and in the past, this has indicated a recession 100% of the time. So this is something you want to pay attention to. Obviously, I believe that we've been in a recession for some time now, but the government doesn't see it that way in the U.S. The bond market is telling us that we are in a recession, as just over 55% of all those yield curves are inverted. And if you look at the 2 and the 10-year yield curve, which is what most people do look at for a yield curve inversion, this is actually the deepest it's been in a while. So the Treasury yield curve hits its deepest inversion in 4 decades. The traditional recession indicator looks very, very negative. So it's as deep as it's been since 1980. That would suggest a pretty bad recession. Usually a stock market crash follows that. And yeah, we're in a bear market right now, but we haven't seen a stock market crash like we've seen during these other time periods in 2008, even 2020, 2008, 2000, the late 80s and the early 80s when we saw those crashes. We haven't seen anything like that yet. We like to look at this chart too. So if we look back at typical bear markets, the average length of the bear market is 28 months. The median's 18. I like to look at the medians because I think that those are more accurate. So the median length of a bear market is 18 months. The median decline is 32%. We're at almost 10 months, and we're at about 23%. And typically the peak to the trough is 14 months. Again, we're at almost 10 months, and then from trough to recovery is about a year. So we still could definitely have some pain to go. Again, say we had like 6 more months left and 10 more % left to go down. Let's take a look at this. So we could definitely like recover from here and then get a second reading later when we crash down lower, that 10 to 15% or whatever it'll take to get there to the 32% peak to trough or whatever it ends up being. I definitely think that there's definitely some time left in this bear market for sure. But I do want to look at this table and its signs of excessiveness and extremism. So I do want to talk about the signs of a market top first because it's what we saw in 2020, and a lot of what was happening is kind of covered in this table. So you'll see a large number of IPOs, which is what we definitely saw. Obviously, the SPAC craze, IPOs were hitting the market like every week. Rapidly rising prices, excessive leverage, the availability of credit, obviously 0% interest rates helps with that. Over-optimistic front covers of newspapers, magazines, so just that overall market hype, FOMO, very high trading volumes, historically high PDE, EV, EBITDA multiples. I think the S&P 500 was at like a 25 PDE at one point. Art and luxury markets booming, so we definitely saw the art and luxury. We saw investments like wine, NFTs, just general art going through the roof. The financial press and financial TV become favorites. I don't know if I can speak to that one. This time is different is declared. Amateur investors move to equity asset class, so we saw millions of new retail investors come into the market during 2020 and 2021. Innovation leads to euphoria. We definitely saw that in the ARK Invest ETFs and Cathie Wood. Social proof leads to herding. So everyone just kind of flocking to the same stocks and growth stocks during those times. And we definitely saw that in 2020 and 2021. And sure enough, we saw a market top. But let's take a look at what could be more relevant to what's happening right now. And let's look at the signs of a market bottom. So the first is no mergers and acquisitions. I don't think we've quite gotten here yet. Just last week, we saw Adobe make an acquisition. Right now, Microsoft is trying to acquire Activision. So still like the really big mega cap stocks are still acquiring companies. But I do think that's because they have so much cash on hand. Like these companies are the biggest companies of all time. And they're trying to buy up these other companies, their competitors, at cheap prices. And I don't think that necessarily is an indicator that the market is still healthy. I think that they're just trying to consolidate their competitors into their own business. I think if you look at the rest of the market, like 90% of the companies in the S&P 500, you'd see that there's really not a lot of mergers and acquisitions happening. No IPOs. So we've seen a complete drop-off in IPOs in 2022. No new money for venture capital. Low price to sales, EV, EBITDA multiples. I believe the S&P 500 is at like a 14 or 15 P to E right now. Many companies trading below book value. Very low P to E multiple. Central banks eased for 6 to 12 months. So we definitely are not here yet because the central banks are tightening quite heavily still. Recession declared officially. News is stale. So usually when you see the recession declared, that's kind of like a lagging indicator. And usually you will have been in a recession for a while by the time that comes out. Previously, favorite sectors are hated. So ARK Invest, just generally the hyper growth stocks are hated right now. Credit only available to high quality borrowers. Investors are cautious and out of the market. You're starting to see that. Negative front covers of newspapers and magazines. We're definitely seeing a lot of that, especially with what's going on around the world, and negative and depressed consumer sentiment. So we're definitely starting to see a lot of those signals. Not all of them yet, but they are starting to creep into the market for sure. So now let's take a look at the midterm election cycle. So where are we? We're kind of like right here going into October, and usually in a midterm election cycle, you'll see a rally through the end of the year. So let's say we hit the June lows and don't break them, or we go and we capitulate a little bit through the June lows through the end of the year. It wouldn't be abnormal in a midterm election year or a normal year to see kind of a rally through October, November, and December. Those are typically your best months of the year in the stock market. If we take a look at when the bear market might end, I'm obviously looking for a breakthrough of our trend line, but also the 200-day moving average. Each of these green dots represents a time where the market broke up above over the 200-day moving average after being below it for over 100 days. And typically that meant a nice run in the stock market. Obviously right here it didn't, and right here it didn't, but in both those cases we got another reading quite soon after, and the market continued up. So we will most likely get a reading of that whenever we break back above, and it'll be interesting to see how the market reacts after that happens. So let's take a look at Apple. I like to look at Apple because it's the biggest company in the stock market, and it kind of can move the markets if it's making a big move. And it's honestly been kind of a boring stock. It's been holding up better than the rest of the stock market. It went up a lot harder than the market did after the June lows, but it's actually been going down a lot less. It's down less than the market is year to date. It's down less than the market is over the 1 year. And it's kind of been a great place to hold your money in a time of uncertainty, which a lot of people might not think would be the case considering it's a tech company, but it has been one of the safest companies over this past year. So it's kind of sitting on a level that I don't have drawn out. It's kind of sitting near like this 150. There's kind of like a little line of support there. Maybe I should have drawn it out on the chart, but that's where it's at right now. Obviously, if the market capitulates through its June lows, maybe Apple will come back to its June lows, and we'll find a level of support between like 140 and 130, just like somewhere in between there. But I'll be taking a look at that for Apple. As far as the S&P 500 goes, it's looking pretty bearish. Obviously, we've been moving down pretty sharply the past couple of days, so you could see a little bit of recovery, possibly, especially now that we've kind of hit those June lows. But if we do break through the June lows, as I've said on the channel during our Daily Dose episodes, I would expect it to move down pretty hard and maybe hit the channel line as our next level. Obviously, I drew out this level as a possible point of having a little bit of buyer support near that 3,500 level if we break through the June lows. But I just really think if we break through that low, it'll be a lot of panic, and we'd probably hit the channel line is when we would actually see a new bottom. But that's what I'm looking at. Obviously, to the upside, I already mentioned that I won't be convinced of a change of trend till we break through this trend line and through this moving average, which is the 200-day moving average, which we talked about on one of the previous slides. But I want to take a look at the VIX today because it's starting to look like it's moving to the upside. And you definitely want to get a VIX reading pretty high. I said between 45 and 50, but it could even obviously go all the way up to like 80. That's what happened during the COVID crash. This is when you'll see your market bottoms after the VIX spike. So let's say we get some capitulation happening in the market over the next couple of weeks, some real panic selling. I would be looking at the VIX to see if it's legit for a bottom. If it's a great buying opportunity, it would be a lot higher, and I would get a little more greedy then in that sort of panic sell. But I just think it's important to mention because this is a really helpful indicator for everybody in the markets right now. So last but not least, with the charts, we'll take a look at Bitcoin. I mean, y'all know the story on Bitcoin right now if you've been following this channel at all. The 17.5 to the 17.7 is the last point of support for Bitcoin. If it breaks through there, there's no real support until 9 to 12,000 on Bitcoin. That would be a tremendous investment opportunity if it does happen. I am selfishly one of those people that hopes it does happen for the sake of getting in at a great price. I'm not selling any of my Bitcoin right now for fear that it might go to 9 to 12,000, but I would be quite the greedy Bitcoin investor if I got it at 10,000 or 12,000 or 9,000. That would be a great price to hold for the long term. But that's really all I have about Bitcoin. I would expect some trouble maybe if it gets that trend line that we have. That would kind of be more towards the first few days of October, maybe like the second week it would get there if it's still trading in this range by then. But if the stock market does sell off hard next week and we break through those June lows, there's not a lot stopping Bitcoin from doing the same, as it's been pretty heavily correlated with the stock market as of this bear market. But I just want to finish by saying not to get spooked out by these markets. Don't let the media or just the overall vibe of the market kind of throw you off your plan. The most wealth is created by creating a plan and sticking to it, investing through these times, buying great assets at great prices, which is an opportunity we're starting to get now. That's really how you build wealth. It's how you can close the wealth gap. It's how you can set you and your family up for wealth, health, success for generations to come. You have to be disciplined. The market definitely pays people who are the most patient, and you'll see that over the course of time. So I could go on and on all day why it's a good thing to invest during these times of uncertainty and fear. Maybe I'll do a special episode soon on why that is the case. But I just want to say that in a time that's very scary to be an investor, it actually is one of the greatest times to be an investor. The unfortunate thing is we typically don't see why it is the best time to be an investor until after it's too late. So you just have to trust yourself and trust your plan, and just average into the markets, grab your favorite assets, good assets at good or great prices, and you'll be just fine. But I'm going to leave it there. Stay tuned for the Daily Dose episodes this week. I appreciate anyone watching this. Definitely be sure to subscribe here on YouTube or follow us wherever you listen to podcasts. Maybe I will do, maybe next weekend, a second episode over the weekend on why times like right now are great times to be an investor. But other than that, I will see you in the next episode.